Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. Got another great show for you. I know you've heard that before, and now we're bringing you 2 shows a week on Monday and Thursday. I just want to remind you that we have 10-minute clips on my YouTube channel. It's Jonathan Green RE, and those go over 4 highlights from each episode, and you get to see us there. So check those out. Ring the bell on YouTube. Follow, subscribe, do all those podcast things. This week, my guest is Stephanie Walter of Erbe Wealth. She's going to talk to you about shattering money myths, how the wealthy invest. This is a great show. Stay tuned. Let's go. This is episode 64 of Zen and the Art of Real Estate Investing with my guest, Stephanie Walter. Stephanie is a wealth strategist, speaker, syndicator, and the CEO of Erbe Wealth. She teaches hardworking professional people to unlearn what most of us have been wired to think about money. Her new book, Shattering Money Myths, How the Wealthy Invest, is out now. Stephanie, welcome to the show.
Thank you so much for having me.
Yeah, it's a pleasure to talk to you. I always like to start in the same place. When you were growing up, did you have an interest in real estate?
Not necessarily. I mean, like when I was a child, no, not really.
Yeah. When was the first time where you thought real estate might be a vehicle for you financially or otherwise in the future?
I think when I was in my I would say my early 20s, and I would see my dad. He purchased different pieces of real estate, and I liked it. It always made sense to me. So I didn't start investing myself until I was 30. So.
Yeah. What kind of investments was your dad into that you were looking at the time thinking, oh, this might be something?
He would do a little bit of everything. He converted a house into his office, and that was a big undertaking. And I remember being like 10 or 11, going and doing yard work and stuff over there. Yeah. And then he had like an interest in small commercial pieces of property that he could get a good deal on. So, yeah.
Yeah, and was he investing locally, like in the town that you live? That's what my dad did too, and that's how I learned too. I was just looking at like, why is he buying all these junky buildings? Yes. And then I figured it out later.
Yes, that's it. That's exactly it. He did it right in Colorado. So yeah.
Yeah. Mm-hmm. And so at what point did you decide, this looks fun for me as well? And then of course you transitioned into what you're doing now at your company through another career.
Yeah, no, I think I was 30, a little over 30, and I bought my first single family property, and then I transitioned that into a rental. So I guess I was doing the BRRRR strategy, and I was single at the time. So my realtor at the time said that I was like the slumlord of Sloan's Lake, because he hated this area in Colorado called Sloan's Lake was sort of dumpy at the time. Yeah. And I just was like, no, this area is going to be good. I know it's going to be good. It's so close to Denver. It has to be good. And sure enough, it completely turned around. But yeah.
Yeah. Do you feel like the neighborhood identification was something important for you at the beginning? Like across my career, that's always been a good thing in single family investment, just knowing which areas are, nobody else really thinks they're going to be great, but I knew. It sounds like that's what you were onto.
Yep. That was me as well. I just felt like and that was the area I invested heavily in and got a lot of good deals in there, and they were all somewhat close together, so it made it easier for managing too.
Yeah. Did you feel like when you were doing renovations in that area that you were also helping the cycle that you wanted to happen as well? Because as one person has to start, fixing up the homes in the area, and then if you get a couple, you can really push it along yourself.
Yeah, yeah. I really loved that. I just love that area, still do. But, the houses are built so beautifully. Like one on property I bought had carpet in there from probably, I don't know, the 80s. And so we pulled all the carpet out, repainted it, and it just has those beautiful hardwood floors. And I just love older houses with a lot of character.
Yeah, absolutely. I think a lot of your new flippers are ruining older houses because they're trying to like take the soul out of the house when we should be capitalizing on it, using it, and then knowing like it's not supposed to be for everybody.
Right.
Like you can't turn this beautiful character driven houses with nooks and crannies into a McMansion or cookie cutter. That defeats the whole purpose of it.
Correct. Yeah, 100%.
Yeah. So where did you go from there in your investment journey? And then, of course, we'll get to, where you are with Erbe Wealth.
Yeah. Well, I was actually, while I was buying single family homes, I owned an insurance agency, and that was kind of what I was doing for my retirement. And so then in 2016, I was brought into a boot camp that talked about buying apartments. And that was when I was first exposed to the concept syndication.
Yeah.
Is where just a group of people are buying a property that no one could do on their own. And I love that concept. And so, I just went and got signed up and did training for, 2 years, really to get your master's in commercial real estate, essentially. And then from there, I started buying, did my first syndication in 2018. And I met up with my partner, and I was good at raising money and he was good at finding deals. And so that's where we just sort of did 12 deals together up at this point, and raised a lot of money from the wealthy, and by dealing with them, learned a lot about how they were handling their finances, which was really different than the way I was. So yeah, that was my next step for sure, was into syndication.
Yeah. And have you found that that's something that still is able to maintain a kind of this group dynamic works in real estate investing, where in other areas people think that it might not? But, the pooling of funds and, delivering the information can really set you up for opportunities that you wouldn't have otherwise.
Mm-hmm. Yep, I agree. It's definitely allowed us to buy, some pretty big pieces of property. That's for sure.
Are you guys looking for those 12 deals? Are those all apartment complexes, or are there other opportunities in there?
Nope, they're all but one. One of them is a retail center, but other than that, they're all apartments.
Yeah. So let's take a quick stop on raising money. And then, of course, we'll get to what you do now with the wealth options for basically accredited investors, right? Which we'll get to.
I think maybe our first couple ones were 506Bs, where we could allow non-accredited, but then we transitioned over to the 506Cs, which are accredited investors only.
Yeah. Okay, great. We'll talk about that. When you first started raising money, what do you think, maybe a couple tips for others, who maybe have the background, they understand what syndications are, but they don't understand how to, I guess, get money from people the right way?
Yeah. The best advice, because I tried so many different things when I started, I really had no clue what I was doing. I was just one of those that was going to ask everybody. I had no problem asking, but I learned a lot of things that worked and didn't work. I think the biggest thing I tell myself today to do back then was to get a group of people that are on an email list that you regularly email. Basically, it can be as simple as just sharing a link about what's going on in the real estate community that you're looking at, and, just touching base and kind of positioning yourself as someone that is doing this and knows what they're doing. And essentially I think that's the best way to get For me, it was I had a lot of referrals. Once you start dealing with people with money and you do good by them, then you get lots of referrals from people. But
Yeah.
I think a lot of people have a group of people, that listen to them for whatever reason, and they should really take advantage of that, even if they don't have a deal right now.
Yeah, and it gets progressively easier. One deal, then you have some tread to show people what you've done. And now, obviously, where you guys are now, 12 deals, there's a lot for people to look at. So it's not as much a pitch as more of a presentation. Hey, this is what we're doing. If you guys want in on it, great. If not, we have plenty of other opportunities.
Mm-hmm. Yes, that is
Yeah.
correct.
Yeah. But what about for what about for the first one? I think you were saying like a great tapping mechanism is your personal sphere, people who've done business with you maybe in your other businesses, because then you already have built a trust relationship
Yeah.
there.
I had not anyone that really was my insurance client, but I had people that knew, like, that referred me business, and I went out to approach them just to let them know what I was doing, just because they were always so good at sending me insurance referrals. And that was one of my first groups I presented in front of. Was this guy was like, yeah, okay, would you mind talking to this mentor of mine, and then I'll bring a few more people in. And that was my first on the spot presentation, and got one of my first investors from that, who's been he's a good friend, and he's invested in about 4 deals with me. So it's just constantly telling people what you're doing. Would you like to listen to? Because I think actually this type of real estate is not that hard of a sell. I'm not sure why. Everybody real estate sounds exciting, and they love the idea of not managing it. So I find this is actually an easier sell than some of the other financial things I talk about.
Yeah, that makes sense to me. I mean, I feel like it's a dedicated return. It's also a tangible asset. So somebody knows it's not just going to evaporate into the air, that something could happen like crypto or something.
Mm-hmm.
And like you said, you don't have to participate in the management, but you can say, hey, I'm invested in this 200 unit apartment building. Everyone says they don't tell everyone they're an LP with a limited percentage, but
Right.
Exactly.
I
think a lot of people want to invest and don't have the time. And that's actually the people that really work for you, that you figured out, professionals who don't really have the time to do it all themselves. They're a great option for syndications and other options that you guys do at your company.
Yes, absolutely.
Yeah. So in terms of the back half of your book, How the Wealthy Invest, you had said before that you found that they were investing much differently than you were. What were the differences that you found, that you're still working with that hypothesis now?
Yeah, well, I think the biggest thing is their mindset and how they're looking. I look at money like most every other person did at that time. I was viewing my investments as accumulating. My idea was I was going to keep buying these rental properties. I really didn't care how much they were cash flowing, but in 30 years, they'd be paid off, and then I could retire. And that was my whole plan. And the wealthy come from a different perspective. They use the utilization mindset. So they're constantly using their money any and all times to generate usually cash flow, sometimes appreciation, but they know at any time that their money is working for them, similar to like an employee. What are you doing for me today? And that's when I realized that I had these properties and I was cash flowing maybe $100, a couple of $100 every month. And that certainly wasn't in line with, the equity that I was working with in those properties. So then that's when I, repositioned a lot of my assets, and I was able to, sell my agency because I'd replaced my business income at that time. But most people, every American pretty much that has a 401k looks at their money as accumulation mindset, and they put the money into a 401k and they set it and forget it. They don't know what it's invested in or the fees or anything like that. And that is just not what a wealthy person does with their money.
Yeah, I feel like the $100 cash flow a month, which is common for like turnkey single families, sounds good in theory, like you said, because you're accumulating assets. But oftentimes, those that are on the lower cash flow, it's because you bought high, the renovations are done. So the appreciation's also limited in the long term, instead of finding areas like you said that you found where maybe there is a windfall of appreciation
Mhm.
over the long term. Yeah, it's interesting. The Millionaire Next Door, I always think is a great book because it's always the people who have the most money you wouldn't expect. And they practice exactly the principles that you are doing. Is that what your dad did? Because that's what my dad did. He was figuring out cash flow opportunities on everything.
Yeah.
Didn't always get the renters to pay. That was my job. But it was interesting to watch that, like, a lot of our parents and friends, like, not that much has changed. They were really doing it then. I feel like they were ahead of their time in terms of figuring out how to create income streams and also leave stuff to their kids.
Yeah, yeah, I 100% agree. My dad was like that. As he got older, he kind of prided himself on finding the best deal on a car. And I remember one time came to pick me up at the airport with like this old Toyota. He's like, I bought it for 1,000, or I bought it for $500. It's like, can you believe I bought it for $500? And then he drove it for a few years and then sold it for 1,000, and he was like thrilled about that. So,
Yeah.
but you,
Long-term usage and a break even. That's definitely a win-win.
yeah.
Yeah. But that's the traditional millionaire next door philosophy. What can you get out of your assets and how can you make them grow over time?
Mhm.
So what do you guys do at Erbe Wealth now, and how did you get to that as a career outside of after you sold your insurance business?
I was really inspired by my investors and how they view money, and just really felt like, I'd been on a few podcasts and people were asking me some different things about wealthy people, and I was like, gosh, I bet I could come up with at least 10. And so I wrote a book, and that's really been my passion, is to talk to people about viewing their money differently and taking more control of the money, educating people, and, helping them achieve wealth. Because I read articles every day. I don't know, they get sent to my phone about how unprepared people are for retirement. And it's really, it upsets me. I think it's like the average amount in a 401k for like a 50-year-old is like a little over 100,000, and you're just like, all these people are gonna work forever.
Yeah.
And they have to do something different than what they're doing right now to get different results.
Yeah. What are some of the biggest money myths out there? I know that's what your book about. Where are people making mistakes thinking that they know and they really do not know?
I think the biggest mistake is not to say that people shouldn't invest in their 401k, but they should be more actively involved in what it's being invested in. They should know what sort of fees they're being charged, because fees like the compounding interest are very significant. And a difference between paying a 1% fee over a 3% fee can mean, $100,000 and possibly working another 10 years. So just becoming more aware of your investments, but actually diversifying, because that's what you see the wealthy do, truly diversify in non-market assets. So whether those be real estate or, private equity, or even insurance products are consistently used by the wealthy to achieve different things. But that is a truly diversified portfolio, not diversifying your stocks and mutual funds within your 401k. So I think that's a lot of misinformation.
Yeah, real estate's I always think is an asset that's interesting because you can be so diversified. It is still one asset base, so of course you should have other opportunities out there, but there's so many different kinds of real estate investing that you can do that bring different type of returns. You could invest passively in a syndication, you can buy your own, you can now do Airbnb, you can flip houses. There's so many options. Have you found that more investors are diversifying a larger portfolio of real estate because it's tangible as opposed to stocks where it's just money in banks. We don't know if it really exists. Is the money there? Real estate's much easier to quantify because you can go see it, stand on it.
Yeah. No, that's myself. I am definitely, I'm pretty all in real estate. I've invested in every deal that we've done. And yes, I feel like there's differences in each property, in each market. You can definitely diversify. Now, coming out of, as we'll be selling a few this year, I'm definitely going to truly diversify a bit out of real estate. I'm going to keep definitely a portion in real estate, but do some more diversification. But there's, like what you're saying, there's like notes in which you could invest in that there's a lot of opportunities in credit right now. There's a wide variety of what I love about this type of investing is that, when you're going into the investment, whatever it is, they'll tell you what their fees are. All right. And they most likely project your returns after the fees have been figured out. So that's completely the opposite in a 401k. Most people have no idea how many fees they're being charged or what that means. So initially it can seem a little confusing to go through and read these documents that pertain to a deal, but they're pretty similar, once you get the hang of it.
Yeah, I think just like we were saying, you get more credibility the more syndications you do as, the GP or syndicator. Certainly as an LP investor in syndications, after you do your first one, you're much more well-versed to at least do due diligence on the next ones, which will help you over time. Have you found that the syndicator pool has become bigger? It seems like everybody is a syndicator these days, and I think it's partly due to social media, but...
Yeah. Oh yeah. There's a ton of syndicators. I get approached a lot because I've raised a lot of money up to this point, and I'm not raising money for anyone else. Just because of that, there's so many people involved in this space, and you honestly really don't know how they're going to manage the property. Everybody's concerned with closing their first or second deal, but very few people are prepared to do what it's going to take to manage this property to get the returns that they promise their investors and have the mental capacity to go over the challenges that will inevitably come up in a syndication. So there's a lot of moving parts.
Yeah, just for the people who are looking to invest out here now, now's not a great time to invest with an inexperienced syndicator. There's so many things going on in terms of like price fluctuations, price to value. Insurance on the large scale is just a huge factor now that wasn't, a few years ago. And it doesn't look like the insurance issue is going away with all the weather anomalies and things, especially in the South.
No, I'm actually in Colorado, and we have, I don't know, my sister's an agent, and we just she has some fears of people pulling out here too, because we have fires, we have hail, we had torrential rains this year. So it's scary when people start pulling out of states, and I don't think that's going to stop anytime soon.
Yeah. It could be cyclical, and then they eventually come back to it after we realize this is just like the new way of weather working. But yeah, it's interesting. Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there. So in terms of your syndications, of the 12 of them, What state are you all in Colorado, or are you outside of there as well?
No, actually, we have one, I have one that's in Fort Collins, Colorado. Then we have, with my partner, I have one that's in Waco, Texas. All the rest of them are in Florida.
Oh, yeah. Okay.
Yeah, so we're well aware of all
Insurance.
those things you're stating,
Yeah.
hurricanes and weather. But yeah, I mean, we have stopped acquiring. That was in July of 2022. That was our last acquisition. Now we're just sitting and waiting. And largely, I personally am pretty interested in Colorado or Cheyenne, possibly places that are closer to me. So
Yeah.
that might be the next places I'm looking at. Sioux Falls, South Dakota, just a lot of interesting stuff going on in and near me. And I do want to diversify, not all in Florida.
Yeah.
Certainly.
Yeah. I mean, I lived in Florida 14 years, did a lot of investing there. It served me well. And it was always had the weather issues. I mean, I paid, all of the insurance for years being close to the water. But yeah, it's interesting to watch all the markets. And again, still when other people are fleeing as a real estate investor, to me, that means like, okay, well, there's going to be deals there, because I do think everything comes back around at some point.
Yeah, for sure. I was down there at the end of March, and there's just building galore. I can tell you, we drove all of our properties there from one end of the state to the other, and I could not get over the traffic and the building that's going
Yeah.
on there. Yeah.
Yeah, I mean, when I lived in Sarasota, this is probably 15 years ago now, like the entire downtown was, there was cranes everywhere. Everything was going up. And I'm sure there's still, even those areas, they build one and then they just find room to build another one.
Mm-hmm.
Florida is always going to be that snowbird destination, for now. So
Yeah.
it's always attractive for second residences as well.
Yeah. I mean, they still have a net migration. I mean, they've got, I think it's like 1,000 people a month are going to Orlando.
Yeah.
So, I mean, that's just one city there. So, yeah.
Yeah, I think people choose Orlando because it's in the middle of the state. They think they'll avoid the coastal stuff, but it usually passes through. Florida's not that wide in general.
No.
Yeah, so maybe give us another myth that people have about money that is maybe hanging them up that you can help us with.
Well, I think one of the more surprising ones is that the wealthy don't get wealthy. They don't invest in high risk investments largely. That's a broad generalization, but I found it to be very true. Most people, they want to invest in low risk. Low risk average returns, or low risk high returns, like asymmetrical returns, but they're not looking to lose. They don't want to lose their money or have the risk of losing their money. And it's just sort of like the Warren Buffett, his two rules of money, which is, rule one, don't lose money. Rule two, don't forget rule number one.
Yeah.
So,
Yeah.
that's what they do. And when you look at the stock market and people, last year, I think on average, they lost like 25%. That's just not, something that wealthy people do. They leave a very small part of their portfolio to invest in, let's say, their favorite stock or a cryptocurrency, maybe 5% of their assets they'll leave for that type of stuff. But they're investing in stuff that's well vetted and has very low risk involved with it.
Yeah, and I think because of that investment strategy, they can allocate that 5% to more risky investments where if it blows up, it blows up, but you could hit it big, that startup investing, crypto. Crypto's not for me. I like startups, but yeah, it's also interesting. I think, seasoned investors or people who have a decent amount of money, they're often great private lenders for others because of the same thing. They're going to get a dedicated return. It's secured by an asset that they can see and hear about, but they're smart. They're just willing to take an easy 8% over where it would sit somewhere else to hold and work with someone that they know. Have you seen that on the private money front as well?
Oh yeah, yeah. I have an investor. He's one of my really good friends, an older gentleman who's really very smart, and I learn a lot from him. He had just found a deal, hard money. He does it all the time, and this person was going to pay him 12% over the next 3 years. And I mean, that's a pretty nice return.
Yeah, exactly.
you know,
It's
for
securable too. You have lien status, you know what's there. And I think if you vetted the person that you're lending, and, big deal. It takes, I think like traditional hard money is capped at 1 year, but I never understood, like for private money, they'll give it to you for longer. It's a very, very safe, like you said, you can get 12%, like fantastic. I mean, hard money now is like at 15% for new investors, and there's people paying that. And that comes with like 2 to 3 points also, which is insane.
yeah. Yeah, it is. But yeah, he has a strategy in a way that he looks at the values and he looks at it in a very conservative way. And if it makes sense, that's something he'll do. But that's kind of the philosophy of an investor, is they're always, looking at, what their money can do for them, which is very different than the average investor.
Yeah, that makes sense. So for you guys, when you're doing syndications, like right now, what would you be looking for? The market's a little weird for finding like large apartments. They're out there, but there's a price differential that sellers haven't reacted to the buying market now. What would you be looking for now, in terms of a larger scale deal?
I think, we're just taking a break in Florida, but I've been personally looking in areas of Colorado where there's major growth. There's major growth in Greeley, Colorado. There's also major growth happening in Cheyenne, Wyoming. And I'm looking for, just an off-market deal, but I've been told that it's very likely to find some of these deals coming up towards the end of this year that may be underpriced a bit, and like a retail service center. So basically, people think, oh no, not with Amazon, but these are retail service centers that have service related industries. So they've got like a nail salon, hair salon, restaurants, stuff like that. That I found with a property that we had here in Florida that performs really, really well, and not a lot of intensive management involved with that. The multifamily, there's a lot of moving parts in that.
Yeah, I agree. Yeah. Even smaller scale strip malls, 5 units and stuff are great because generally people take care of their commercial business. They're running a business. So your upkeep, and like, it's not like having your regular tenants who call you with a plumbing issue. They're going to fix most everything we're required to via the lease anyway.
Yes, correct. 1,000%. Yeah.
Yeah. So, I mean, with the current landscape of how everything is, where do you think the syndication game is going? Do you think it's just a matter of, like you said, you're waiting it out, looking at different opportunities? Because I feel like everybody wants to doom and gloom like the real estate market, but there's closings every day. There's syndications closing every day. How are you going about just weighing, like you said, other areas? Are you looking at other asset classes as well?
Yeah. Just like I like retail. And so that's the one that I know that if you can get in at a good price, it certainly pays off. But yeah, looking at other areas, but quite honestly, just, before we make a big purchase, just holding off right now. I think, yeah, you're right. There's closings going on all the time, but I don't feel doom and gloom, but I do feel like there'll be, we're going into more of a buyer's market. Just a cycle, that has happened over many, many times, going from buyers to sellers markets. But yeah, I definitely think that that's coming. I also think that some syndications haven't been run, or people didn't secure long-term debt. I know this for a fact.
Yeah.
And if they weren't able to build in value to the property, so add value to so that it's appreciated somewhat, which is hard to do in a couple of years. then they can't refinance. So there might be some, there might be some deals in that way, but no, in no way do I think it's gonna, collapse things and there'll be a huge problem with commercial real estate. Traditionally and historically, commercial real estate always performs well during recessions. So,
Yeah.
I mean, obviously not office, but
Yeah, right. I mean, the office, but office redevelopment now seems to me the play. What's going to be converted from office to residential? Which areas will that work? I think that's where the big money's at. We're in a housing shortage. There's tons of vacant commercial real estate. Who's going to start doing all the redevelopment? Because it needs to happen. Because it's not going to, like you said, it's not going to go back to commercial. There's just way too much square footage available that nobody's going to rent. I also think, like you said, there is this commercial debt issue coming towards the end of the year where a lot of it's going to be up, and that does mean it's a good time to buy. I've been the same. I've been like not investing barely, just doing little things here and there because the numbers just don't make sense for me, and I'm not in a rush. I've been doing this long enough, and I think, for syndicators also, it's wise to not have to push into deals. They'll come, and if somebody brings you something good, then you can activate on that. But yeah, I don't think we need to be in a hurry. I'm on board with you on that one as well.
Yeah, I agree.
Does that commercial redevelopment interest you at all? There's so much commercial out there that large scale. I think there can be some bigger redevelopment opportunities.
Yeah, we only have one development and it isn't a redevelopment. And just from what kind of a headache that one's been, I don't know on that one.
Yeah.
Maybe work with someone that is very experienced and wants to handle all these headaches. But I know there's a lot of motels, hotels getting redeveloped into multifamily. So maybe something smaller like that.
Yeah, I think those are great plays. I mean, everybody talks about building, but there's opportunities there for vacant commercials. So somebody's have to do something. I mean, it's hard to turn a Toys R Us that's in like a regular shopping center into residential because it doesn't match what they are. But there's definitely other opportunities, that have been sunk over the years.
Oh, for sure. Yeah.
Yeah. So tell us a little bit more about the book. It is Shattering Money Myths, How the Wealthy Invest. I know we talked about it a little, but any other tidbits from the book? And then where can people find it?
Well, my favorite chapter is the 10th chapter, which talks about tax treatment diversification. And that's where a lot of people just are going to kind of be stuck when they retire without having to address the investing in tax, either, tax beneficial, like working within real estate, or there's even opportunities to invest where you're given tax-free income when you retire. And the wealthy are always definitely being involved in all of these strategies, whereas I think the average American is counting on their 401k. We've got close to $32 trillion in debt right now. Historically, we're at about 40% tax rate, but historically, that's one of the lowest rates that we've had since income tax was rolled out in 1913. If you average it from that time until now, the average rate was like 58.6. Wow. So there's going to be, the tax rates are definitely, I have no crystal ball, but if you're counting on tax rates being the same in another 20 years, you're probably mistaken on that. Yeah. So you have to have some sort of diversification within your portfolio to tax advantaged or tax-free income.
Yeah, and so where is the book available everywhere? Widespread, Amazon, all the stuff?
I don't have it quite on Amazon yet, but it's on my website and I'm offering it free to download.
Okay, so that is at erbewealth.com, and that's ERBE wealth.com.
Yes.
Okay, that's great. One thing I wanted to bring up, a tip that your dad had given you back in the day, that you will never lose money on real estate if you don't have to sell by a certain date. I love that. Definitely something my dad just probably said to me verbatim at some point. So tell us a little bit about that and how it kind of shaped the way you looked at real estate and money.
Well, I can remember like when I started doing the investing and I'd have friends and they'd be like, "Aren't you just like so scared that, something could happen?" And I'm always, just like thinking, what is it that could happen? Because I mean, it's still a house and this is a good area and people want to
You have
move
insurance.
Yeah. And someone wants to say they don't want to pay their rent. I never, knock on wood, ever had to evict anyone, but they'll usually, you replace the person that you considered to be bad. And it just always made sense to me. So that's why I'm grateful to my dad. But yeah, I've seen that firsthand when I was an insurance agent. Like I remember that I had people flipping homes, actually right before the Great Recession, and they got stuck. They got stuck. Then quite recently, I had a lady that I knew that was doing a fix and flip. And she got stuck right in the middle of this inflation rise, the supply chain, as she ended up putting $100,000 more into the house than she thought she was going to.
Yeah.
So she was lucky enough to be able to, rent it out and wait for the market to come back. And she'll be fine. But I mean, it's very hard to lose money in real estate unless, like my dad said, you have a timeline in which you have to sell it because it's always going to appreciate. You mentioned that we have a severe housing shortage. And I think another point to that is you're seeing a lot of large companies buying up lots of single family homes.
Yeah.
And so, it is happening and you should definitely be looking at real estate to put part of your diversification for your retirement for sure into it.
Yeah, I think too many people think like if they're not getting dedicated cash flow off of a property that they turn into a rental, that then it's a loss. But like, what if it's just a downturn and you can rent it, even if you're losing money, and then 3 years later, ooh, now the town's up, everything's up. You could lose $200,000, like you said, just because of a timing issue, which all of us in investing, you kind of feel like you have to sell something. And then, 2 years later, you're like, well, definitely shouldn't have sold that.
Yeah, exactly.
That's, again, though, part of diversification and portfolios like we talked about. So the best place for people to get in touch with you is that at erbewealth.com?
Yep. That's the best. There's a lot of information on there, education, and you can sign up to get the book and be on our email list where I try to, send lots of educational stuff probably once a month or so.
Yeah. Well, fantastic. It was great speaking to you. I love the knowledge that you brought to us. It's a great different point of view. And I really think that we gave them a lot of information to process now.
Yeah. Thank you so much. I had a great time.
All right. That was episode 64 of Zen and the Art of Real Estate Investing with my guest, Stephanie Walter of Erbe Wealth. I'm Jonathan Green. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.